Okay. A couple of attendees filtering in. We'll give them a minute. Are you a black coffee person or a cream or a?
No, just the way God intended it to be drank. Just straight out the espresso machine and throw some hot water in it.
I wish I was that way, but I'm an oat milk girl, so.
Yeah, my wife is too. We taught our 8-year-old son how to make lattes on our espresso machine, and he thinks it's like the coolest thing ever. And so now he's even trying to figure out how to do like latte art and stuff. So
wow,
I've been getting spoiled. He's like, I know. He's like, I'm going to go make you an Americano. I'm like,
I was going to say, then the more talent he has, the more coffee he can make you. So
that's pretty much it. So I'm sure it'll be a phase, and he'll decide he doesn't like to do it anymore, and I'll have to go back to making my own. But for now, I'll take it. So
yeah, take it while you've got it. All right. For those of you who have joined us, thanks for being here. We're going to give it another probably 1 or 2 minutes for people to join, and then we will jump in because we have a lot to cover. Ron, are you up in the Midwest?
Grand Rapids, Michigan. It's currently, it can't decide whether it wants to rain or snow. So we're supposed to get like a 1/2 inch to 1 inch of ice, which is just glorious for February. Yeah. So this entire city can't decide if it needs to shut down and declare an emergency and cancel everything, or if we're just going to do what we always do, which is just drive through it and continue on. So we'll see.
Right. Yeah. Having grown up in Wisconsin, I get it. I'm in Colorado right now, and we've got a pretty big storm coming through, but not ice. It's like skiable snow. So
that is where I'm jealous. Ours is snow or ice, and there are no mountains. So there's really nothing you can do with it other than scrape off your car. So.
It's a good environment for productivity, though.
Yeah, except the only downside is Michigan. I think the last time I checked our stats, we get like the least number of sunny days of any state outside of like the Washington, Seattle area. So, yeah.
Wow.
Mm-hmm.
It's a far cry from Florida, where I usually am, where we have like 362 days of sunshine.
Yeah, St. Pete has the record for the most sunny days in a row, I think. Yeah.
Yes, we do.
Oh, hopefully one day. It's still on my to-do list to get an office open there. Just, as you know, running a startup, every time you think you've got a great roadmap and everything's planned, something comes along and you got to pivot just a little bit, or, make an adjustment. So it's the story of my life.
No, I hear you, but we would love to have you down there.
Me too. I would love to be down there as well. So maybe 2024.
One more minute, and then we will get started. Try to schedule these around what is hopefully people's lunch break, but with time zones and such, you never know.
Mm-hmm.
All right, it is 12:35 Eastern. There may be some more people that trickle in, but we are going to dive in. So thanks everyone for being here. For those of you who don't know him, it is my pleasure to introduce and welcome Ron. He is the founder and CEO of Lifeworks Advisors. And they are doing some incredibly innovative work to fix major problems in the financial planning and advising space. We're going to hear a little bit about that today. And Lifeworks is also powered by data from Intrinio. And I can vouch and tell you from working very closely on the back end with data that Ron has some brilliant engineers working with him. He has built a phenomenal team. So Ron, thank you for joining us. Thanks for being here.
Yeah, thanks for having me, Rachel. And I do have an awesome team, and I am the low guy on the IQ totem pole. So hopefully none of the questions will get too technical, but I'll do my best. So
right. We'll see what happens. But I second that similar situation. Former programmer, but it's been years. So, so for the people that don't know about Lifeworks or know about you, Ron, can you start by giving them a little bit of a background, kind of like how, your background and how you ended up founding Lifeworks in the first place?
Yeah. I'll try and do a quick origin story. So I spent about a decade at a large national financial services firm, very traditional insurance based, and they started a wealth management division. And fairly quickly into my time there, I was really frustrated with what I saw as the brokenness of the financial advising and financial planning industry. And towards the end of 2016, my business partner and I decided to break off and start our own Scratch RIA. And originally, we believed that we need to solve a couple of big challenges between the wealth management industry and clients. And the first was that the entire industry was essentially giving away for free what clients wanted more of, which was personalized experiences, personalized planning. And they were continuing to charge what we thought were excessive fees for the thing that should be becoming more automated and more commoditized, which is investment management. So for those of you who aren't familiar, 96 cents of every dollar of revenue in the wealth management industry is generated from some type of assets under management fee. And for the last 20 years, that fee range is generally 1%. There's no magic to it. It's just that's where it got stuck, and it's kind of been there. And so what's happening is in the early 2000s, late 2000s, we started seeing the rise of robo-advisors that were bringing scale, speed, affordability, democratizing access to the market. And the industry at first kind of had this, oh, this is going to create all this fee compression. It's going to be bad in the long run for consumers. I happen to think that's the opposite. I think it's done amazing things. But what we started seeing was that advisors needed to build a much more personalized experience. So we left a large firm, started a Scratch RIA, and our original goal was to build a subscription-based financial planning model. So no more, account minimums, no more how much are you worth before I decide if I'll work with you. Instead, we said we need three things in our business model. It has to be simple, it has to be transparent, and it needs to be fair. And we believed then, and we still believe now, that providing really great fiduciary level financial planning that's accessible and that's also usable to clients is something that's really needed. We had tremendous success in 2017 when we launched in terms of growing our clients. And what we realized was there wasn't any software for running a subscription-based, highly personalized financial planning firm. And so we started to build our own, right? We had one of those, E-Myth moments, those entrepreneurial seizures. And so we started building some software. And part of the evolution that came was we also came to realize that the investment management or the asset management side of our business, we believe, was also fatally flawed as well. So for most people watching, you have probably encountered something called a risk tolerance questionnaire or a risk score or a model portfolio. So part of how the traditional wealth management industry and even the robo-advisors have made investment management scalable is they build model portfolios, right? They basically pre-select a group of ETFs or mutual funds or maybe even individual equities, and then they assign the percentage of those holdings to a client based off of how the client feels about risk. So if you've had a 401k or if you've worked the robo, you've filled out a couple things, maybe done a little risk slider bar, and then bam, you get a 70% equity portfolio and 30% fixed income or something like that. Quick analogy to there, and then I'll tell what we started building and why we connected with Intrinio. The majority of the wealth management industry relies on risk tolerance questionnaires and risk scores for determining how a client's investment should be done. The analogy here is this: you're not feeling well, and you're not feeling well for a few days. And so you decide to call your doctor, and you go see your doctor. And your doctor says, I'm not really sure what's wrong with you, Rachel, but let's run some tests. Your doctor runs some tests and comes back in and says, Rachel, I have really bad news for you. You have cancer. Now, nobody wants that news. And when the shock of that wears off, imagine how you'd feel if your doctor took their script pad and flipped it around and said, how do you feel about chemotherapy and radiation, and how much do you want to have? That's essentially what, it's almost ubiquitous across the industry, advisors and robo-advising platforms do. The client showing up saying, I have a symptom, I'm worried about retirement, I need to save for something, I need to plan for my kids' college, and we build investment strategies for clients then based off of how they feel, which studies have shown can change based on whether you fought with your partner that morning, whether the traffic was bad, whether the weather's, it changes every day. What clients really need is they need the doctor to say, look, having cancer isn't going to kill you. We can get through this, but here's what you need to do. Mm-hmm. So Lifeworks set out to fix the financial planning piece, and we had tremendous success there. And I think we did some really innovative stuff. We're still one of the only subscription-based financial planning firms in the country. But along the way, we realized we also needed to fix how investment portfolios were created for clients. So I partnered with a group, a company that was founded by a couple of guys from MIT. You mentioned the really bright people on my team. That is those guys.
Yep.
And what we said is we need to have the same deeply personalized experience on the investment management side as we've been bringing on the financial planning side.
Right.
And so our systems now, when we're doing financial planning, calculate exactly what you need to achieve in terms of rate of return in order to make all of your financial planning goals happen. And then we custom build a portfolio of individual equities that has the highest probability of achieving that and the lowest volatility possible.
Right.
And we call that the right benchmark. I don't care whether the S&P 500 goes up or down. I mean, generally we all care, I guess, but on an individual level, on an individual level, like, how do you answer the question for a client that goes something like this? The S&P 500 is down 20. Mr. Client, your investment portfolio is only down 10. In traditional asset management settings, I should break my arm off patting myself on the back because I outperformed the S&P 500 by 10%.
Right.
But your financial plan now is still in danger of failing because we didn't hit your benchmark.
Right.
And so something that you and I had kind of talked about email leading up to this, like what would some of the conversation topics be? I believe that whether you're on the technology side building solutions or whether you're like me, whose background is an advisor, we have to keep moving towards bringing deeply personalized experiences and solutions for clients, which requires access to great data, it requires technology, and it just requires a different mindset.
Absolutely.
So that's the Lifeworks story.
Yeah. Let's come back to that personalization because I want to go back to a phrase that you used. You said entrepreneurial seizure, and never in my life have I understood what you meant by that. Everybody has slight pivots in the beginning, right? And we've both of our businesses have had to do that. And sometimes in direct response to requests from clients and personalization for clients. So I definitely want to come back to that personalization piece. But first, let's take a moment to acknowledge SaaS for advising, right? Like, I was going to ask you, is there anybody else on the market at all that is using a subscription-based model for advising? It's brilliant, but I think you mentioned nobody else is doing that, right?
Yeah, there's a couple now. One that pops to mind, and he's been on my interview series. Facet Wealth was started by a guy by the name of Anders Jones, and he has two other partners. They're really doing something similar. They have an annual kind of like contract, but it's an annual subscription. But they started with a kind of a similar focus. They wanted to provide financial advising and planning for everybody, regardless of net worth. So there's a few, but when you look at the wealth management and financial advising industry, right, it's insanely fragmented. There are the large wirehouses, Morgan Stanley, Merrill Lynch, Goldman, Wells Fargo, think that. They're the large national insurance firms that try and do everything, right? So think like Northwestern Mutual, Mass Mutual, New York Life, Guardian, and I'm not saying anything bad about any of these. It is what it is.
Right.
And then they have advisors that work in their systems. And then you've got what are called independent broker dealers. And then the fastest growing area of the wealth management industry is in the RIA space, right? The registered investment advisor space. And that's the one that's the most fragmented. There's like 15,000, 17,000, maybe RIAs, something like this. And most of us are boutique, small organizations and enterprises relative to the size of the $60 trillion of, retail assets in the United States.
Right.
I think the largest RIA is something like $500 billion of assets, right? So even the largest of us is still, a rounding error. So it's like deeply fragmented business creates a massive opportunity, but there are small individual advisors running really small localized niche practices that I've talked to that are running some subscription stuff, but nobody's really trying to build a platform
at scale,
at a national level at scale to do this. Yeah, we're pretty unique in that space.
That's amazing. As another SaaS founder, I get it and I love it. So, and now to start to get back a little bit into the personalization piece. I mean, I'm a personal user of one of the main robo-advisors. Like I have some money in there and I am consistently frustrated because it's stocks, bonds, right? Like, just like you said. And I'd always felt that, I think in general, the robo-advisory space as a segment within fintech is struggling right now. And I think part of it is that they went the first mile and then they stopped, right? It's like they went so simple that it's too simple, and it's frustrating for anybody who knows even just a little bit about investing to be just like harnessed into those two choices. And so I understand the value proposition and the use case of Lifeworks deeply, because it's extremely frustrating for someone like me.
Yeah, you run into a couple of things. I mean, when I started Lifeworks, one of the things we did is we went and opened accounts on what I would consider to be all the leading robo platforms.
Yeah.
And part of it was super frustrating because I looked at the traditional space that I was in as well, and I was like, our client experience is terrible. It's just awful relative to a Wealthfront or a Betterment or a Robinhood or something like this. And so part of our vision for Lifeworks is how can we learn from what the robo-advisors did, that first mile that they went, right? Which is, how do you democratize it? How do you make it simple? How do you make it user-friendly? But where they fell short, I shouldn't say that, they're all super successful, but where I think the disconnect has started to happen with consumers is, look, if anybody can build, an ETF portfolio based on a risk score, and anybody can do digital account opening, like that's all ubiquitous now. It's table stakes, it's out there thanks to places like Apex Clearing, like that's known, right? But how do you choose between a Roth IRA and a traditional? Or how do you choose between a solo 401k and a SEP? Or how do you choose between not doing either because you're an entrepreneur of a SaaS company, but yet at the same time you need to do, let's call it some risk management. Right. And I'm not talking insurance. I'm talking like, hey, our funding was delayed and we need to turn our salary off for a few months while we're waiting for the next round to come in, or whatever these things are. Those require a deeply humanized or personalized experience. And there's this tension between building for scale, which the robos have done well, but then making it deeply personal, right? And so you actually are seeing robo-advisors. I'll use Betterment as an example. I've not connected in any way financially. Disclaimer, I'm not saying anything bad about them. They actually started having an option where clients could select to work with a human advisor and pay a little bit more, right? And so I think what we're going to see, this is Ron prognosticating here, I think what we're going to see is this mixture of robo-advising like systems for scale on the investment side. And then the best firms are going to adopt some type of subscription-based or accessible-based financial advising model that you can subscribe to when you need it and use it, and then know that your investments are probably managed, very efficiently. Now, we think we should be doing it in a more personalized approach, but I think we're going to see more of this hybrid between human advice and robo-advisors.
Right, it has to happen, and that's digging into the personalization piece. And I think it's such an interesting time to be talking about the importance of personalizing for our end users, because with the economy and the environment the way it is right now, and the whole venture and tech landscape just like imploding around us, thankfully both of us are doing just fine, right? But a lot of companies aren't. A lot of the advice coming out of like the venture and tech world is do what your customers are asking right now. Like be personalized, you do follow what your customers say and build for them. Like that's what I keep hearing, the advice coming out of the venture industry right now in this environment. And our version of that at Intrinio is financial data used to be all or nothing, right? Like similarly, almost there's a parallel here with both of our businesses and both of our industries, right? It was like you buy a whole Bloomberg terminal. Okay, what if I just want insider transactions? Too bad, millions of dollars a year, right? And so there's a dangerous place where you can go too personalized and it becomes really expensive for you to do that. But by unbundling some of those data feeds, that's kind of our version of saying, no, if you only want end of day data, you don't have to pay for real time, right? Like really splitting things apart like that to make it easier. And there's probably still more we could do. We're constantly listening to our customers, but give us some more detail on what that means inside the product for you guys for the personalization piece.
Yeah, so an example here, and this would be a use case for where we started, down the rabbit hole of we need to get data. So we've done the Bloomberg terminal, we've had the Morningstar conversations and other large data providers, and I've had to recover in shell shock from the high six-figure price they wanted for data on an annual basis. And I'm like, I only need 3 things, right, or 3 sets. And they're like, well, if you buy this equities, you got to get all the mutual fund data. It's like, okay. So to give an example, we run a quantitative investment platform. So we use factors to filter the US equity markets. We're using Intrinio data to look at, really detailed information in 10K and 10Q filings. So we're filtering for R&D, we're filtering for book value, we're filtering for sub-investments inside of companies underneath the publicly traded company. Right. And then let's say we use that to filter the S&P 500, and we have very granular details on it. Now you show up, Rachel, as a client, and you work with one of our advisors, and we build you a cash flow model, right, and tax projections from today until we use age 100 just to be safe. Hopefully all of us live longer, but 100 is probably a good target, right? And then we have to say, okay, you have a technology company that serves the finance space. So we're going to exclude financial sectors from your investment strategy because you've got 95% of your net worth already tied to that.
Yep.
That's a simple example of personalization, but that's the right direction.
Right.
The second piece of that is, well, instead of doing what the robos did for the most part was just, providing ETFs, which are a very efficient and kind of broad market diversification strategy, we said we can be even more efficient and we can cut out those fees by using, let's say direct indexing and smart beta. So we're taking our factors, we're applying it to the US equity markets, and then we're building, portfolios generally around 50 equities for a client that are specific and germane to their financial plan, right? Which requires that we have the ability to go look at all that underlying data, not just price data, not just volatility data, but again, looking at the filing information so we can be very intelligently, building the filters correctly, building our factors correctly, and then applying it to the individual client.
Right. That's incredibly cool. I mean, that appeals to me quite a bit. Who are you finding, like what type of target market and users responding to this model versus like the full handheld traditional boutique individual low tech advisor on one end and the robo advisor with like nothing on the other end? Like, who is this resonating with?
Yeah, so we have there's a couple of really good industry studies that are done every 2 years. E&Y has one called their Global Wealth Management Report for anybody building to fintech or wealth tech or in this space. They have the 2019 and the 2022 one out. They're fantastic 50-page reads. I would highly recommend it. But they've been saying something in there now for the last 4 or 5 years since I've been subscribing to this report. And McKinsey has one and Deloitte has one. They all kind of say the same thing. And the fastest growing adopter of fintech are the baby boomers.
I just read this the other day. Yeah.
So
this last week.
This is really important because when we think about users of fintech, what comes to mind is this like, Gen Z, old Gen Z, young millennial, right? I mean, I was on a interview a while back and they called me an old millennial because I'm 41. I'm like right at the cutoff, right? And I was like, okay, fine. But so the fastest growing adopter of fintech are the baby boomer age group. And that's very, very important to know because I think a lot of the fintech and early robo advisors and solutions were also kind of built for this like younger persona, right? So like, I'll use like an Acorn or a Stash as an example, like round up transactions, stick a few bucks a day in. And what we've been seeing at Lifeworks, and we've tried to be intentional about this, is what we call a barbell approach to the product, which is we have to win the perpetual 35-year-old. Right. So we're not trying to win the 18-year-old. There's some arguments for that, but we're trying to win the 35-year-old upwardly mobile next generation wealth creator. And they've grown up with technology. Some people call them digital natives, whatever, right? They have 3, 4, 5 different fintechs on their phone. They use them every week.
Yeah.
Right. Then you have the other end of the spectrum, which is the baby boomer generation, and they control 75% of all the public traded equities in the United States are held by the baby boomers. 75%. So if you're building fintech, yes, the 25% that's not held by the baby boomers is still a massive market, right? But you can build something that's attractive to a younger next-gen wealth creator or user. And interestingly enough, we've been finding that it's just as attractive, if not more so, for the 60, 65-year-old, because they want to be involved in something that is going to be iterated on and innovative and continually delivering service to them as they're moving through their retirement. They're now becoming accustomed, and I say this, kind of as a blanket statement. Our take on it is they're becoming accustomed to, hey, I'm on vacation right now at my house in Florida, and I want to move $50,000 from my investment account to my checking account, and I don't want to pay any fees for that. And I'm going to turn around and then move it from my checking account to buy the car down here that I want. Like, we get that kind of stuff all the time. That's fintech in action, but for a baby boomer. Right. So I think that there's an opportunity for builders to say you can maybe break a rule here and not be like super, super niche and have a very like narrowly defined user. You could maybe define a user as somebody who has an appreciation for seamless fintech software. And then it likely will apply to both ends of the age spectrum, the baby boomers and what I would kind of say this like perpetual 35-year-old. That's what we've been finding, at least.
That makes a lot of sense. Yeah, the boomers was a surprise to me, but now we know. Also, for our listeners, a reminder to you guys that we do have Q&A enabled. So fire away at us if you guys, as we go through this, if you guys have questions for Ron or myself about either of the businesses, the models, fintech, robo-advisory, anything, fire them at us. I can see the questions coming through and we'll answer them on the fly. So drop them if you have them. I have kind of what maybe a hard question for you, Ron. And this just popped into my head. I'm thinking about your business model, right? And how just the sheer volume of assets under management across all of these RIAs across the country. And even in St. Petersburg, where technically Intrinio is headquartered, we've got this huge Raymond James presence, which is like insanely massive. And then we had Dynasty Financial Partners move to town, another $100 billion+ business of connection of RIAs. Is your vision for the company to stay standalone, or have you thought through potential to be almost B2B in a sense, to open up the technology as something that all those advisors could use? Or is the vision more to keep this all in-house? Because Lord knows they all need it, right? Yeah. They're all operating in a very old school way.
When we started Lifeworks, it was really client focused in the B2C space. And then even when we started building software, it was very much like we were building it for ourselves. And then in 2020, one of the realizations that I had I met the owner of one of the largest RIAs in the country. His name's Marty Bicknell. He's one of our lead investors, really fantastic guy, runs a very large $100+ billion investment shop, financial advising firm. And what I started seeing was the same problems and challenges we were solving as a startup, scrappy RIA, were the exact same problems multiplied by 6, 7 more zeros for these large firms. And so we pivoted to say, well, we have a B2C channel, and that's kind of where our origin story started, and we have clients there and we have advisors there. But the biggest impact that I believe Lifeworks is going to be able to make is actually rolling our platform out for growth-focused advisors. And that's the key word, growth-focused advisors. Advisors who are just happy doing what they've always done because they've done it that way for 30 years, they're not my target market. Advisors that want to serve their clients across multiple generations and that recognize they need the ability to potentially have a subscription-based business model if they want to win the next gen of clients. They want to have a really great digital client experience. So we are just now kind of opening up our platform for individual advisors to join.
Oh, very cool.
One of the unique things is that adds a little challenge to this is I can't just offer our software as a service and maybe a traditional SaaS model because we have licensing requirements.
Right.
So the upside is Lifeworks is an RIA. The advisors that join us can use our RIA and can then benefit from having their licenses held here, and then they get the software. Right. So we had some large firms ask us if we would basically build our software and white label it to them. And so far, our answer to that is probably going to be no, because we don't see that being industry transformative. We just see it being something that a handful of advisors at a big organization with 20,000 advisors decides to let people use. And they're not fully adopting the mindset. They're not shifting, business models. They're not shifting deliverables.
But do you think that will change? Do you think there will be some pressure on them in the future?
I think that the average age of an this is going to be a long answer for you, Rachel. I think that
that's okay.
I think the change is going to move very slow for a couple of reasons. One, the average age of an advisor in the United States is 60, maybe 61 now. Yeah. There are more certified financial planners over the age of 70 than under the age of 30.
Wow.
A couple more things. The average firm across the industry grew at roughly a 19% CAGR for the last 5 years. The S&P 500's CAGR was 16 point something, which means that the average large firm in our industry is growing at something slightly better than inflation.
Right.
i.e., they're not growing at all. What they're doing right now, and the reason I think that it's going to be a while before you see transformation, it's going to take a next generation of advisors kind of coming up and being the majority. But the biggest firms in the industry are just buying the other big firms in the industry. I'd point to the Schwab TD merger. You can also do a little Googling and see that the industry is just going bonkers with M&A, right? It's more about buying your neighbor's backyard in playing an economy of scale on the size premium than it is being innovative and changing. So if you're a large firm with 7 layers of executives and middle managers before you get to the advisor, most of these places have to maintain their business model, because if they adopted a Lifeworks business model of just a transparent subscription base, then like, how do you tell the advisor, well, we're taking 50% of that from you, Mr. Advisor, because we're the firm. So like Lifeworks, for advisors that join us, like they keep 100% of their revenue.
Yeah. Yeah.
Right. So we at zero can build an innovative business model and disrupt it, because I don't have to, lose 80% of my revenue in changing the business model. So I think it's going to be a while yet. I think the big firms are going to really try and hang on to this. But what I'm seeing with the young growth-focused advisors is that they recognize this shift is happening and they want to be part of that shift. So you see the younger growth-focused advisors starting their own firms, going independent, partnering with a Lifeworks, and I think that's going to be, that's going to be the slow change that kind of pushes this monster industry.
I have to agree with you. As someone who's had employees at Raymond James like reach out wanting to buy data, and then their boss goes, or their boss says about their boss, right? Because there's like 17 layers. This is great, but like my boss doesn't know what PowerPoint is. How am I going to explain what an API is to them? And I'm like,
sure. Or why do we even need it? Can't you just go get Morningstar, or a Bloomberg terminal? Yeah.
Right. Like it's just the tech focus and the desire to change or innovate is not there yet. I think it'll happen eventually, but maybe a future business model for you. So we did have a question come in. You had mentioned and acknowledged, right, that there are some firms out there that are doing a hybrid model already, and they're starting to kind of inch. This question came from Tim, and he said, Schwab and Fidelity, those types of bigger businesses do offer hybrid models. So give us some more detail about what the differentiator is between your type of hybrid and what those big guys are doing.
Yeah, so I mean, you see a tension. I'm actually going to use Merrill Lynch and Schwab as examples here. Fidelity obviously has a retail presence. So let's take Merrill Lynch a second. They built something called Merrill Edge a few years back. People watching this may or may not have seen it. They do a lot of advertising on Twitter, which has kind of been my favorite social media platform as of late. And what they're hoping, right, and I can't speak to the exact strategy, but watching from the outside and talking to some advisors, they're forcing their advisors to use that platform for new clients in order to get some additional revenue payouts on their traditional book of business, right? So I think the large firms look at hybrid models. Schwab has a $99 a month like personalized financial planning model, but that's not where they make the bulk of their money. And so in business, you measure what matters and you monetize what matters, right? And so what the large direct-to-consumer firms are still doing is it's not a personalized experience. There is a CFP, it's a 1-800 number. And so I think the difference between what we've seen, this is anecdotal, not empirical, I don't have a study on it, but what we've seen the difference being is how you do financial planning and advising when it's done by an individual advisor who is being hired directly by the client and the client's paying them. Like our model, we go through values, vision, strategy. So it's a very deeply personalized approach. And there's also systems and tools around it. When I look at the large firms, right, they're essentially still trying to give away the human financial advice to get the assets in-house. That's where 96% of their revenue comes from, right? So there's just a difference in how the planning is done. Theoretically, any firm could run a hybrid model and could offer a highly personalized financial planning experience, but most are not. One, either because they're big enough they don't have to, right? Or two, it's because it's not where they make most of their money.
Right. Yeah, right? I mean, what you're doing to me makes sense, because why beat your head against the wall trying to sell software to an industry of people who don't want to innovate? You just disrupt them on your own, right? You just do it on your own and offer a service that a certain target market really actually cares about quite a bit. So
yeah, and I think the other side too is a software company getting acquired by a large traditional firm, the success rates around those, and at least in my industry, I can't speak to others, is very, very low. What we see is acquisitions happen and they make perfect sense on paper or on the PowerPoint, And then an implementation, it ends up taking 2, 3, 4, 5 years to integrate. And by the time that happens, the software is now outdated and everybody's kind of forgot the energy around it, and it gets relinquished to the dustbin of history. So I mean, who knows? We'll see, but I think that the incentive for innovation is different depending on the business model. And our industry is going through this challenge around what the business model should be and how it's monetized, right? So like that's still kind of being worked out, right? And the amount of revenue behind the scenes, and companies like a Schwab, I'm not saying anything negative about them, they have their own funds, they have their own bank, they have their own methods of monetizing payment for order flows, secured, fully secured lending, interest carry, things like this. Like that's where they make the bulk of their money. Right. So what is really truly their incentive for going out there and having 1,000 or 2,000 or 3,000 like true, like personalized financial advisor, focused people? I mean, it would still be just to get the assets in the door to monetize, interest carry or payment for order flow or any other ways that they currently make the bulk of their revenue.
Right. So that was a good question, Tim. Thank you. Anybody else has questions? Feel free to drop them in the Q&A. Let's stay on that like attitude for a second of like just the resistance to innovation. Because one of my favorite things about doing these like Fintech CEO webinars we do every month is just like, we face so many of the same challenges, right? I'm in data, you're in advising tech, but like in the fintech space, it's so many of the same challenges. And to like completely shift gears out of like the product and into just like the business at whole, one of the challenges we faced in our early days was that attitude, that like not understanding the innovation piece, just like the way it's always been done through the investor lens, right? Of investors going, but there's a Bloomberg terminal. And I'm like, no, that has nothing to do. We're not selling software, we're selling API access. Like, and it just, but like everybody in our early days had that attitude. It was like, no way you're going to disrupt this space, right? Like these things already exist. This is the way it's always been done. And like, we had to really weasel our way into some like tech savvy investors that actually knew what an API was, but it was one of the most frustrating things in the early days because we knew what we were onto and we needed funders. And it sounds like you got really lucky. I forget the name of the guy that you said was one of your investors who came from the advising space, but it doesn't sound like he has that attitude. So how did you find him? And have you experienced that with other investors that you've worked with, that attitude?
Yeah, so one, I mean, it was fortuitous. One of my favorite quotes is by Branch Rickey. And the end of it says that luck is the residue of design. Luck is a fact, but it's not a factor. So my first attempt at building software, mid-2018 through the end of 2018, we were supposed to launch, kind of like version 1 of what we were building in January of 19. And the firm that I had hired to build some of that, it just completely fell flat, right? There was nothing there. So I'd burned a bunch of money, felt like a complete total failure. My business coach said, hey, join me in Vegas for this industry event. I'm like, the last thing I want to do is spend more money. And so he said, come. And so I went, and I ended up having this kind of like, fortuitous sequence of events where I met an individual who then introduced me to Marty Bicknell, who's the CEO of Mariner. And I pitched our idea to a handful of, let's say, more traditional like VCs and investors. And I got things similar back. They're like, well, this already exists out there. There's like Orion and eMoney and Money Guy Pro and Investment's already doing this. And there's this CRM and this CRM. And I'm like, look, I run a very tech forward RIA. It takes us 16 different software platforms to run my small tech forward firm. Like that's not scalable, that's not sustainable. And the solution isn't to just build a standalone software to do one thing, which is what our industry's kind of done. We've got this just massive discombobulation of software that they're good softwares and they do like a thing or another thing. And then, their whole pitch is, well, we integrate with each other and there's no common data source. There's no way to scale it. You don't own the data. I mean, it's just a complete mess. So then I just did a use case presentation basically for Marty and his leadership team. And I said, how do I become a client of your firm? And like the room gets really quiet. There's like 14 people in there. And I said, hold on to that. And I opened up a web browser and I said, how do I become a client of this robo-advisor? And everybody's like, well, you click get started. It's like, why can't we make it that easy for somebody to become a client of a traditional financial advisor? Like, we should do this. And, he gets it. And so he's been a fantastic investor. So anybody that's looking to raise money, I think if you have something where it already appears like the market's completely saturated. I had one VC told me, he's like, oh, this is like red ocean, like this is nothing. It's like, okay. Yeah. It's good to get pushback, as you know. Yeah. But then I was like, no, this isn't nothing. I actually am running a firm. Like, I'm living this. I know this problem exists. And so I think that finding somebody who is willing to invest in innovating in their industry, that individual investor becomes the great anchor, right, with which you can build off of. We may never go and do a traditional VC round now, just because of our growth and where we're going. Right. But yeah, trying to explain this, it wouldn't be the worst thing, but yeah, trying to explain a complex, solution and not something that's like, we're going to do digital account opening and do a robo-advisor, like that was easily understood. What we were trying to pitch at the time and still are was like, hey, there's these big challenges to the industry. We're going to solve it by building this essentially operating system for an RIA to run on. And yes, it's a big idea, and yes, it's going to take a long time, and yes, it's like us trying to build a silver bullet, but we think we can do it. Right. So. Yeah.
You get lucky with some investors sometimes. Well, not luck, right? What was the quote again?
Luck is the residue of design.
Correct. So I regret saying that. It wasn't luck, but you find the one sometimes, and it's like a ripple effect, right? And in true form, the entrepreneurial seizure, right? I was there too in our early days. I ended up barely affording a ticket to fly to Singapore to speak about AI at a data conference, and I don't eat seafood, and I ended up eating crab legs on the ocean somewhere with some guy who helps manage the Singapore Sovereign Wealth Fund, and ended up with 4 investors in Singapore. But that feeling of being that far out on a limb is such a wild thing that I think most the average human spends their entire life not having a feeling like that. It takes a lot of grit as a fintech founder to go through that. But thankfully both of us are not in the early stages anymore. And
sometimes I look back and I think to myself, if I knew what I knew now, I'd do it all over again. Another one of a book I really have enjoyed referencing and going back to and reading is Originals by Adam Grant. And he talks about in there that the propensity for people to take risks and innovate is actually greater for people who have less to lose and who actually are slightly lower on the IQ spectrum. Right. So the higher you go on the IQ spectrum and the higher you go on the financial success spectrum, the less likely you are to innovate and do something original because you have more to risk and lose. So I always tell people I'm just smart enough to maybe have seen the opportunity, but I am completely dumb enough to actually try it. Yeah. Which is that recipe of this is a big opportunity. I can see it. I don't know exactly how we're going to do it, but I'm going to just keep banging into the brick wall until we either knock it down or it knocks me out. And I think that's the spirit, or if anybody's watching this and they're a builder getting ready to raise money, I think that's what you just have to hang on to. As you know, Rachel, you just gotta grab onto the thing and keep pushing. So
and hold on to the passion, right? Anyone who's ever given me money has done so almost exclusively because it's clear how passionate I am about what I do and that I believe in it, right? So your ability, as you said, to turn to the guy that challenged you. Oh my God, we probably both had hundreds of investors be like, you're an idiot. This is never going to work. You have to fight back against that and let your passion shine through, because that's what people are they're investing in us, right? We're the leaders of our companies. So we had a really nice comment come through. It wasn't a question but from Xavier. This has been awesome. I love the service. I think only the client that gets it and the advisor that gets it will be the perfect fit. You're right, Xavier. So thank you for that kind comment. All right. So another fintech founder question for you, because we've been through the ugly stages of the early days of hearing all the no's and the original fundraising for the business. And now we're both of our businesses are scaling, right? And so I think if we have any listeners who are also at that stage, it's interesting. Our businesses face a lot of different challenges with scaling, but for you, right, you have a lot of benefits over platforms like a Betterment, but Betterment scales way easy, right? So how are you thinking through those challenges, and any tips or tactics that you've used, or the way you're thinking about scaling something that's not so just like A/B?
Yeah, this was our story for last year. because I'm so close to the business. There's in some ways, Lifeworks is Ron and Ron is Lifeworks. And we had a bit of an identity crisis, right? Like we have a really great B2C, let's say business channel or revenue model. And startup last year, I was like, look, we win in this space when we go out and do digital advertising. And that is like, we could not be trying to build a platform for advisors and just build this ourselves and go be a super successful RIA. That's the safe path, because that was my known path, right? Building a platform and then trying to make it available for advisors. So we had this tension there. What ended up happening was, and I think I've seen this in other founders as well, we have a vision of what the end product needs to be. And everything short of that feels like it's not ready yet, or we're trying to do too much at once. So last year, I look back, and one of the biggest mistakes that I made as a leader of the organization was not really focusing in and truly adopting an MVP mindset, because I knew what our platform needed to do to serve me and the advisors who work alongside me. And so I let us do too many things at once. We had like 10 big projects going at one time. And instead of getting them all done on time, none of them got done on time.
God, can I relate?
So I think the scale thing comes in here, especially when you have a complex business model like mine. I just have to be okay saying, like, this is not going to be able to do that yet. We have to do this next thing, and we have to do it really, really well. And it always takes longer than I want it to. And I don't feel like I'm moving fast enough. And then I look back now and I'm like, man, I'm still way far ahead of everybody else, even though I feel like I'm moving at a snail's pace. So I think the key to building something for scale, one is building the business that your client wants. That's one of my 10 truths that I tell every financial advisor and entrepreneur. Like, you have to build the business your client wants. You already mentioned that. But two, I think we have to be willing to sacrifice what our end vision is in the short run to live with what we can do, and then continually improve on that. We raced to build too many features too fast, and then we should have been focusing in on the quality of what we already had and making that better and faster and scalable, right? Adding a new feature was less difficult than trying to take what we had already built and make it better. So
I resonate so much with this, and I think it is a common challenge with almost every founder, because not yet is the last thing that we want. Like, that is not how we are built, right? We want to take over the world and do it all and do it now. And it's so hard to say no to things. Not yet is better though, right? And it's like the discipline to actually say that and follow through with it is really hard. I mean, we've made mistakes like that too at Intrinio. We built a natural language processing engine to build qualitative data sets off of the SEC, and then nobody wanted to use it because it was like not perfect. And we had like one engineer working on it. And I'm like, stay on the quantitative data, Rachel. Like, we don't need to do GPT-3 right now, right? Like, but it was so tempting because it was cool and it was fun. And I thought it was interesting, but our customers didn't. And we ended up wasting some resources on it. And so it is really, really tough to have that focus. But I think similar to what you've said, I don't like to look back and say, oh, I regret this, or I would have done this differently, because neither of us would be sitting where we are right now with successful scaling businesses during a shit show tech year. But the focus
might have a little bit more cash left in our bank account from our last fundraising round, but
right. Well, also that, but like, I could probably name 10 projects we just should not have done, like, at all. Like, half of them never do, and then half of them like just not done when we did them, and that discipline is tough.
It is.
So branching on to the tech implosion that's happening around us right now. We both have really unique views. For us, we almost have like kind of like a leading indicator of what's happening with the economy, because we oftentimes sell data to really early stage companies. If they don't get funded or run into cash flow issues, like, we see that the smallest of companies are affected first when the economy tanks, right? And so we had some customers that had some cash flow issues, like nothing serious, but over the past 6 to 9 months, like, that has started to become a bit of a thing, right? And I think there's a lot of questions in the air about what's going to happen in the economy right now. But you also have a very interesting, I have some friends who are financial advisors, right? And they're like panicking right now because everybody's calling them and like, am I going to make money this year? Right? Like, so I guess a couple of your thoughts on the economic situation, and then where you feel that with your client base, kind of like what you're noticing.
Yeah, so I think, we have two clients essentially. We have the end user, which is, I still tell our team, is our primary client, the client who are, we're managing assets for and we're doing planning for. And then we have let's say, our direct client, which is the advisor. I think we're in a season of discontent, is kind of how I look at it right now. And there's clearly lots of reasons to be nervous about different things, whether it's geopolitical things, whether it's the war in Ukraine and Russia, and the possibility of like a escalation between nuclear powers. I mean, that's the thing that keeps me up the most at night. I can do nothing about it. I find myself worrying about the things I can do the least about. But I do believe that there is a general worry that people have picked up on around the financial system and the markets and the validity of the idea that what worked in the past will work going forward. And there's so much of the financial markets that are predicated on this, right? So your friends who are advisors who are fielding calls from their clients. Right. This is a very valid thing. Lifeworks has taken a different approach to how we answer it, but how like we see this is we see, the acceleration of baby boomers retiring, right? The risk that everybody who does retirement planning that's honest, the real risk to a person retiring is not their loss of principal. It's the fact that every year, everything they're going to need to live on is going to cost more. And so what we see on our end is this like, well, how much more? And how do you plan for 8, 10, 15, 20% increases in those costs? Drives a lot of unease. However, as an entrepreneur, I'm also an eternal optimist, because to live in the pessimistic world, if you take it to its logical conclusion, you can only do 3 things: God, gold, and guns, which I tell people we don't plan in that space, and you shouldn't. I think whenever there's discontent and there's misalignment between whether it's politics and people, whether it's the money and the clients using it, it creates opportunity to solve these challenges. And as much unease I have about things that I can't control, whether it's inflation, the monetary system, geopolitics, I'm more excited every day because I see the opportunity to bring a differentiated business model that has a better economic system for clients and advisors to market. In fact, selfishly, the more discontent that exists in the space for a while, it probably will help us scale and grow faster. When everybody's comfortable and you don't have to make an innovative decision yet, or you don't have to decide to move to a new platform, I think it slows down the things that are just a necessary part of, the change that's happening. So I don't know if that's a good answer to the question. I mean, there's lots of things to be kind of worried or negative about in regards to the economy. I'm glad I'm not out there fundraising right now. I'm glad I'm, not rewound 3 years from where we're at. But at the same time, I'm also optimistic because this will create opportunities for people who are willing to move at the speed of the world. So there's a quote by a gentleman by the name of Peter Sheehan, and his quote goes something like this: the rate of change that we experienced in the last 12 months will be the slowest rate of change we experience for the rest of our lives. Right. And so the people who get comfortable being continuously uncomfortable, right, and just make that their normal, I think can swim at the pace and will do amazing stuff. And if you can't adjust to that, then if your team isn't innovating at the speed with which the world's changing around you, you're getting left behind. There's no other option. So
totally agree. I agree. I'm also very happy that I'm not fundraising right now. Thank you. Neither of us are. But yeah, it is a wild, it feels like it's a wild time, but to your point, it's just always going to be that way, right? I mean, we lost 2 customers this year because they were in Ukraine, right? Yeah. Like that is wild. Like we're losing customers because of a war. Like that's never something I've dealt with before. That's terrible. But to your point, like we're arguably some of the people who are best set up to handle environments like this because we like to push the innovation envelope and we do well in uncomfortable situations and with change, and it's only going to get more intense. So we've only got 5 minutes left, and I want to end on a positive note since we just covered war and the crashing economy around us. So tell us like what's coming next for Lifeworks Advisors. I'm sure you have a bunch of new fans now who are going to check it out. What can we be on the lookout for? What are you most excited about for the company? What's coming next?
Yeah, so what's coming next is this year we are going to be really accelerating what is the most innovative thing we do, which is directly connecting financial planning and investing. So we have MVP models and a lot of tools and technology built that sits behind the scenes, and our big initiative for this year is getting it into our application. So imagine you're working with your advisor and you're building your budget, you're linking your assets, you're creating a financial plan. I'll call it our back end of our system is essentially calculating in real time the portfolio that's the most applicable to your financial plan with the highest probability of success. So right now those live in a couple of different systems because we had to build the MVPs and then we've been iterating on them, and this year we're bringing those together so that the work that our clients and advisors will do is they'll focus on the financial plan, and then we will take care of the portfolio customization and the investments for them.
Wow.
We also just finished our integration. I haven't made it public yet, but we finished our integration with Apex Clearing. So
Congrats.
digital account opening, fractional shares, real-time ACH transfers, all the tools that the robos have used for years that have made their systems super easy to navigate. We've built those now for advisors. And
That's
we're
fantastic.
just starting to open accounts. Yeah, we'll probably make a public announcement on that here in the next couple of weeks. But that was a year-long project. That's a really big deal. And that'll create massive, it takes 3 minutes to open and fund an account and transition money from one traditional firm to our platform. And right now it takes us like 3 days to do that on TD Ameritrade, Schwab, or Fidelity, one of the traditional custodians. So we're getting ready to unleash some just massive time savers for advisors and clients. We're really excited about that.
That's huge. I mean, that's a huge, huge advantage. Congrats on the Apex news.
Yeah.
Big. I'm sure there's a lot of work behind the scenes there. So for those of you who are listening, you get a little sneak peek of that. We're also partnered with Apex thanks to Ron for the intro there. So
I'm glad it's thanks to Ron.
Yeah. Awesome. Well, thank you so much for joining us today, Ron, and sharing all of your stories and wisdom. It's always fun to chat with another founder who gets it and has been through it. So thanks for being here. And thank you to all of our attendees for joining us. We do a Fintech CEO webinar every month. So stay tuned for the link to the registration for next month's webinar. But thanks for being here, and thank you so much, Ron. Hopefully I see you in
Thanks for having me,
person.
Rachel. Yes, hopefully we see each other in warmer weather soon. Thanks everybody for attending.
Have a good day, everyone. Thank you.